So we jumped over chapters 5 and 6, and we are in chapter 7 with activity-based costing. Now, I set up a chapter 7 lecture time, let's call it that, for you, only because I think this particular topic is due a little bit more discussion, because it's not always quite intuitive. And what I found when I was reviewing it was they are trying to jump over too much over the why, and I think that part is important for you to understand, and they just jump into the how and start making all the, making all the calculations. I don't think the calculations are difficult, because the calculations function just like the calculations that you have done in chapters 3 and 4, okay? So the big thing to understand is this on this particular topic is, we cannot overemphasize this enough, is that activity-based costing does not meet the standards for qualifying to be used for external financial reporting purposes. So in ACC120, if you remember, our sole focus was external reporting for financial statement purposes. And if you remember all the way back, and some of you are going to be like, oh, seriously? Yep, I'm going to bring up chapter 1 again. Chapter 1 in ACC120, if you remember, one of the principles of accounting that we learned in ACC120 was the matching principle, right? So when we say that we made $100,000 worth of revenue, if we've got $100,000 worth of revenue, we have to match the costs that it took to earn that $100,000 worth of revenue, okay? And in 120, we typically did not have to go too far into the concept of how did we get to cost of goods sold, versus in here, that's all we've been talking about for basically the last 3 chapters, okay, is how do we get to cost of goods sold, okay? So in chapters 3 and 4, we had, keep in mind this, the one thing that has not changed. In chapter 3, direct materials, direct labor, not an issue. It's the same thing whether we have a plant-wide application rate or a department application rate, okay? Or if we use activity-based costing, okay? So direct materials and labor are not an issue, okay? What is at stake here is how we are allocating that overhead. That is those direct costs that function so that, in a way, that we know that if we build one more item, what's going to be the additional cost that's going to go there, okay? So for external financial accounting standards, we got to use plant-wide allocation rate for overhead, or we got to use departmental, period, end story, okay? That meets the standard for external financial reporting purposes, okay? Now, that does not mean that internally we can't use a different way of looking at our costs to figure out some additional, very helpful information to figure out, do we want to make one more item? Do we want to accept that additional customer? What do we want to do with the next order that comes through? Okay? And when we're looking at this activity-based costing, again, the biggest thing here is this, right there, okay? We just simply are going to look at the costs differently. We're going to break them up into different buckets in a slightly different way, okay? So when we looked at this over here, right, this was our process when we were in chapters in 3 and 4, okay? Every bit of the manufacturing cost, so try to imagine that you've got a manufacturing plant. Every bit of that cost at that plant, no matter what it was, is going to get allocated to cost of goods sold in some way, okay? But when we get over here to activity-based costing, not all of that plant cost is going to go to our not necessarily cost of goods sold, because now in this one we're not really talking about a true external cost of goods sold number, okay? But what we are going to look at is we're going to break up the cost in a way where it's more along the lines of shifting all of our variable costs that change with the number of items that we make or the number of times that we do something versus all those fixed costs like the general manufacturing manager's salary, that kind of stuff. Because regardless of how many times we do anything or how many units that we make, that cost doesn't change, okay? So we're looking at all the different versions of how we're going to look at these costs to determine, do we accept that next job, that next group? Do we make another product? Do we need to add a third item into the production process? All these kinds of different things that we're going to use activity-based costing for, okay? But again, do not go in the direction of any kind of direct materials and labor, okay? That hasn't changed. All right, so the other thing that I wanted to point out, because I don't think that it's necessary, let's see, hang on. So again, here's the 5 different levels, right? That was kind of one of the other big items that we're going to get into in this particular activity-based costing. So it's like product level, it's like going to vary with one more unit being processed. Unit level, whether we make one more group of items. Batch level, whether we add another batch to it. Customer level. This gets really interesting because a lot of times when you're looking at the sales for your organization, you can end up with customers that can be, call them kind of high maintenance. When my dad was sort of rolling, kind of wrapping up his business as he was getting closer to retirement age and everything else, he called me and was talking. We were talking about it, and I said, "Look, keep the customers that you want that make it worth your while, and get rid of the other people. It's like if you want to just kind of wind this thing up, then do it that way." And then he just sort of extended out his retirement for several years, just because, there were some customers that were actually worth it, right? But all those customers that were stressful, wouldn't pay, all those kinds of things that just made it not worth it, he got rid of them, okay? And that's the kind of stuff that we're looking at here, all right? Now, here's the other thing that I want you to see. If you might want to print this slide and the other one that we're getting ready to look at, because what I want you to really make sure that you got straight in your head here is that the numbers aren't changing. The sales number is not changing. The net operating loss is not changing. We're taking the same cost and we're just sort of mashing them around a little bit, and we're doing something slightly different on where they're going to show up on an internal cost analysis. So the ones that we're going to look at in this particular situation is we're going to look at that manufacturing overhead that's $14 million. We're then going to also look at the marketing expense of $2 million. And we're going to look at the general administrative expense of $6 million. So again, make sure you're thinking along the lines of, okay, what is already included in this when we're looking at an external financial statement. So when we're looking at that manufacturing overhead of $14 million, again, remember, try to picture a standalone manufacturing facility that is 100% manufacturing focused, and every single thing that is going on in that location is going to be considered manufacturing overhead other than direct materials and labor. So all the accounting people that are there, all the maintenance people that are there, the depreciation on the equipment, depreciation on the building, the general manager's salary, the assistant to the general manager, all those kinds of things are included in that manufacturing overhead. But some of those people, when we change the number of units, when we switch out the number of batches, any of those kinds of things, those costs don't go away, right? They're not even affected at all. So we're trying to look at in ABC costing, we're trying to look at those things that are affected, right? So you've got a lot going on there in that manufacturing overhead. Some of that could be insurance and benefits for somebody who has direct labor that is touching the product. You with me? So there is an awful lot that's going on in that manufacturing overhead. Now the other thing that you probably noticed if you did all your work and everything is that shipping expense now becomes a direct cost to, using ABC costing, becomes a direct cost, because if we didn't have product, we wouldn't need to ship it. So if we didn't have the product, there would be no shipping cost, right? And so that gets moved up to the direct cost, okay? Then think about marketing expense. Well, if we didn't have marketing, we wouldn't have product, and if we didn't have product, we wouldn't have anything to market. So all that needs to be looked at as to how much some of that marketing expense changes and fluctuates and behaves based on how many different kinds of product we have, how many different items of product do we sell, etc. And then general administrative expenses, again, think about the general and administrative expenses in this one as being more of some of the expenses at corporate headquarters, okay? So that's on the external side. But when we flip over here to the activity-based costing, again, notice what happens there. I wish they had given it to us in a slightly different way, but notice what's happening there. We're tying out the production department. There's that $14 million, right, from that previous slide. There's the $6 million from the general and administrative department, and there's the marketing department for $2 million, right? So 14, 6, and 2. So if we back up, whoop, there's our 14, our 6, and our 2, okay? So those are the only items that we're really looking at when we are looking at this. Now again, you've got to picture from the back end side of this, from the accounting side, what you see on the external financial statement can be multiple general ledger accounts that are grouped together. We started to look at that in ACC120 and I want to say that was chapter 6. But we would start grouping things together, like we might take multiple accounts and roll them up into one line item on the income statement that we were trying to put together. So in this particular case, we've got multiple items in the production department. So imagine those as 4 different T accounts where we are tracking those costs within the accounting department. The general and administrative department has 3 different T accounts that are being tracked on exactly what those are. Then you've got the marketing department. Again, there we've got 2 T accounts where we're breaking those apart. So we've got marketing wages and salaries, and then we got selling expenses. Now, let's think through some of this kind of stuff, all right? So when we've got the production department, imagine we're at the factory, right? We've got all those people making product and everything and all the functioning that has to happen to keep that building going. We've got indirect factory wages, okay? So that is indirect wages, so maybe something along the lines of some kind of maintenance department that keeps the machines going. But they're not touching the product, right? They're touching the machines. We could have an in-house HVAC department, electrical department, plumbing department, any of those kinds of things that keep all that product and all that machinery and the building and everything else functioning, okay? Then we've got factory equipment depreciation. So again, think about how that was functioning before. That got thrown into one great big giant bucket, but now we're going to break it out a little bit, okay? So that's just the production equipment, okay? Then we've got factory utilities, okay? So factory utilities, you know, I mean, on some level, you could sort of say that, you know, if we made more product, that maybe during the summertime it takes more to air condition the factory, but then the heat that's produced in the wintertime allows us to dial back the heat, right? But in this one, they're kind of taking a slightly different approach there, that it's like the factory utilities aren't going to be affected much by the number of units that we're producing, the batches that we're producing, and everything else, okay? And then we've got the factory building lease. So you've got very different characters or characteristics of these expenses, even though they're all still in the production department, okay? Then we've got the general and administrative department. Now again, remember that at this point, when we get to the general and administrative department, now we're looking at all those salaries and wages of everybody that has nothing to do with production, right? But we have administrative wages and salaries, the accounting department, the management, whatever it might be. You've got office equipment depreciation, right? You've got administrative building lease. So again, try to imagine a different corporate headquarters that's going on there. Then you've got the marketing department. So the marketing department, we've got the marketing salaries and wages. So some of that might be fixed cost that don't necessarily affect or are affected by the number of items that we sell, but the selling expenses are, okay? So don't lose that. You might want to print that previous slide, print this slide to kind of get your bearings on where we are looking at these different costs, okay? So wanted to make sure that we're all kind of on the same page in that area.